So here in this video, we're going to talk about what to expect tomorrow with CPI and the Fed. We do have Nick Timiraos that gave us some detailed insights to what the Fed is likely discussing today and tomorrow and what the markets could be faced with. Now, Nick Timiraos, for anyone that does not know, is seen as the Fed's mouthpiece, and the details in what he's saying today, well, I think is giving us a heads up on what to expect tomorrow, like a definitive heads up, including CPI probably comes in lower than expected. We are also going to play a clip from Tom Lee, and he specifically talks about why he's bullish on small cap stocks. And I know Tesla is not a small cap stock, but Tesla is very much similar to small cap stocks in the sense of, economically being sensitive, like a small cap name, being interest rate sensitive, like a small cap name. And his opinion on small caps is still very bullish, which, is a good thing. Now, Tom Lee also says that Apple, Nvidia, and Tesla should be core positions in investors' portfolios, which is not something you hear said about Tesla any day by investors, especially not big money investors with an outsized influence like Tom Lee.
Fed meeting kicks off today, kind of a big week when we look at CPI and the Fed decision, but I want to focus on today first. What's your WEX word of the day? How do you see today shaping up?
Well, the WEX word of the day is visibility, because that's what's getting investors anxious about the next couple of days until we hear from the Fed and CPI. I think investors are anxious and they want visibility.
All right, so looking for some visibility. We got some visibility yesterday from Apple. We've been waiting for WWDC and their big artificial intelligence unveil. Stock closed down 2%. I want to get your take on what you heard and what you saw and what you think about the stock.
Well, Apple is one of our granny shots. It's a stock that we think investors need to really hold for the long term. The company has always been at the center of everything that's happening around a consumer and new technologies. So to me, there might have been some head scratching because these features may not be part of someone's life just yet. But as you know, Apple gets a lot of these things right.
All right. So by the way, for the audience, your granny shot, it's kind of like almost a very easy shot. You think it's almost a no-brainer when it comes to that stock, right?
That's right. I think investors should look at it as a core portfolio holding. The granny shots is basically a thematic portfolio that buys the strongest stocks in a specific theme. So when you think of AI and millennials, Apple and Nvidia and Tesla, they're really at the center of that.
All right. But your sector picks when it comes to the AI trade are Nvidia, Cadence, ARM, AMD. Why isn't Apple in there if you believe that it's a core holding and obviously they're pushing into the AI space?
Well, mainly because Apple is much more than just an AI company. So I don't think it's intentional that we left out Apple when we talk about AI trades. But when our clients are looking for direct beta exposure, to them, the complex is Nvidia, and then stocks with high correlations to Nvidia, which are the ones that we actually listed.
All right. So, Tom, know what you're intentional about? Small caps. You've been one of the biggest bulls when it comes to small caps, specifically the IWM ETF. I'm just looking at the small caps since the last Fed decision. They're up 3%. The rest of the market's up about 6.5%. They've been lagging all year long. Is there still a case for small caps to rally as much as 50% this year in your mind?
Oh, yeah, definitely. One thing investors have to keep in mind is small caps get hampered when investors worry about lack of visibility. When the Fed begins to cut, and we actually have shown this to our clients, and the number of expected cuts begins to creep up, that has been correlated with the IWM outperforming the broader market. So the reality is the stock market is saying, look, I don't want to touch small caps until the Fed starts cutting. But in the meantime, small caps have better earnings growth, close to 19% in the Russell 2000 versus around 9% for the S&P. And the median PE multiple is actually around 10 times in the Russell 2000 compared to 16 times for the S&P. So better growth, lower multiples. I think it's a great risk reward for investors right now.
But aren't they also more rate sensitive and also more sensitive to the higher cost of capital and the higher for longer environment? You keep saying that investors don't want to touch them until the Fed starts cutting. We don't have any clarity. We might get some answers tomorrow, but it's unlikely. The Fed's been very clear. They're data dependent.
Sure. But I think what you've just described, which is higher cost of money, or, a a high bar for borrowing money. I mean, that's the existing conditions. So when the Fed starts cutting, that starts to ease. What would investors benefit from is having exposure to things that are levered to an easing of financial conditions. That would actually argue for small caps. So it's a bit of a waiting game, but boy, I mean, I don't know anyone who's made money trying to trade this week to week. Any great ideas? All the great ideas take time to work.
I mean, wow, fair enough there. Is there any part of the small caps that you think are better than others? I mean, all small caps aren't created equal.
Well, one thing I think investors have to keep in mind is that they might think a small cap is like a weak company, but actually small caps, especially in the Russell 2000, tend to be very strong companies that dominate a smaller market. So that's why, they're not $1 trillion company, but they may be number one.
Wow. I mean, you gotta just love Tom Lee, especially if you're a bull. If you're a bear, you're probably sick of him being so right at this point, but he does bring up a very good and valid point in that argument that a lot of Wall Street is not allocated to small caps. Wall Street is waiting for the Fed to start cutting rates. In all reality, small caps are trading at a lower multiple and are going to start seeing accelerating growth much faster than your other mega cap peers. I also think one of the problems with Wall Street generally not wanting to own small caps as of lately is also the fear of a recession. If we go into a recession, small cap obviously gets hit unproportionately hard. So tomorrow will be very important to get clarity from the Fed whether they are waiting too long, maybe waiting for a recession to start cutting rates, or are they going to get ahead of an economic slowdown and start cutting while there's still time? So that's what I want to get into here now, is what to expect coming tomorrow from the Fed. We also have CPI that is going to be a huge catalyst, which, let's be honest, I can't remember any other time in history that you had a CPI report the same day as the Fed. But let's not be confused. Jerome Powell has the CPI report in front of him right now. He already knows what the CPI report is going to be. So as the Fed is going through this meeting, they're taking into account the CPI report that comes out tomorrow. Just, we don't have that yet as investors. So let's start with inflation expectations for tomorrow. Now, core month over month is expected at 0.3%. Keep in mind, the actual expectation is around 0.28%. So that would get rounded up to 0.3. And there's the rounding effect. So you could come in at 0.3%, but the actual number could be 0.34%. And that would be a high 0.3. That would not be as good as like a 0.27, 0.26, or 0.25 that gets rounded up to 3. So there's the rounding effect. Anything over 0.25 will get rounded up to 3. Anything 0.24 or lower will get rounded down to 0.2. Preferably, you would want to see like a 0.24 number that gets rounded down to 0.2. That would be exceptionally good news, but keep in mind, even if we come in on the headline 0.3%, it really depends where that decimal is, whether or not that inflation report tomorrow morning is going to be seen as good news or not. I should also mention last month, core CPI month over month came in at 0.3%. So on a decimal point basis, you're actually expecting a deceleration in month over month core CPI. But again, on the headline basis, it doesn't look like it because we're only expecting marginal improvement, and either way, we should still get rounded to 0.3% as per the market's estimates. Core year over year is expected to fall to 3.5% from 3.6% last month. Headline month over month is expected to come in at 0.1%, down from 0.3% last month. That would be a great headline to hit the news wires. And inflation year over year on the headline is expected to come in unchanged from last month's 3.4%. So I do think inflation, the report that we get tomorrow that the Fed already has right now, is going to be vitally important to whether or not we get 1, 2, or 3 cuts in 2024. But let's be honest, at this point, if the Fed still forecast 3 cuts, that may be seen as bad news for stocks because that would likely mean economic problems. But here's where things get even stranger. This is the dot plot from March 20th, 2024. Keep in mind, CPI comes out between the 10th and 12th of every month. So by March 20th, the last summary of economic projections that we got, you had your January inflation report, your February inflation report, and you ended up getting the March inflation report that had 3 hotter than expected inflation numbers baked into this. Okay? Accelerating inflation. But what did the Fed say on March 20th? Well, the Fed still kept the federal funds rate projection at 4.6% by the end of 2024, the same as they did in December, meaning the Fed still expected 3 cuts in 2024, following 3 inflation reports that were actually reaccelerating. So in theory, if tomorrow's CPI report shows more disinflation, we're going to have 2 disinflationary inflation reports back to back, and that could, well, maybe justify 2 rate cuts at least, if not 3 still. I think one of the biggest wild cards for tomorrow is obviously the Fed funds rate projection. How many cuts are we going to get? Right now, markets seem to be up in the air between 1 and 2, but it's also the GDP projection and the unemployment rate projection. So back in September, on the summary of economic projections, the dot plot, the Fed was expecting 4.1% unemployment for 2024 and 1.4% GDP for 2024. And that was one reason why Wall Street started to price in 5, 6, 7 cuts at one point in 2024, is because lower GDP, higher unemployment. Well, back March 20th, the latest summary of economic projections, what we're looking at here, the Fed actually lowered their unemployment estimate from 4.1 to 4%, and they raised their GDP estimates from 1.4% to 2.1%. So the Fed got more confident that unemployment was going to stay, maybe a little bit lower than they thought, and GDP was going to run higher than they thought. Well, now, wait, you're already at 4% unemployment. And I guess a lot of the economic data has been pretty mixed at the same time, suggesting that maybe growth is slowing down. So does the Fed raise their unemployment expectation? Because right now, we're at the peak unemployment the Fed is expecting for 2024. So odds are that does go up. Now, does GDP fall? And if GDP does fall from their last estimate of 2.1%, how low does it go? And then couple that with how many cuts are we expected to see. So for an example, we could see 3 rate cuts still priced in by the Fed, but maybe we get GDP that comes in at 1.3%. Maybe the Fed thinks there's going to be weaker economic activity throughout 2024 than they thought even back in March. Maybe they expect the unemployment rate will tick up to 4.2%. I don't know if that will be seen as good or bad. I think that's getting way too close to recession to be outright bullish. As I've said on this channel many times, whether or not we get a rate cut in 2024 really doesn't matter, right? Whether we get 1, 2, or 3 does not matter. You want to see inflation fall, and that be the reason why the Fed is cutting rates. If the Fed needs to start cutting rates because economic activity starts to decline or starts to look like it's going to decline in any kind of meaningful way, the S&P on average sells off 23% on the first Fed rate cut because normally the Fed is way too late to start cutting rates. I find it interesting that, it's not really a question at this point. The economy is slowing down. Inflation, hopefully coming tomorrow, we'll get new details, is decelerating, and we're still not expecting that many cuts from the Fed. So I do think tomorrow markets will get a lot more understanding of, are we going into a recession? Is the Fed going to wait too long to start cutting rates? You have also seen the Bank of Canada and the European Central Bank that have already started to cut rates last week, and that could put a little bit more pressure on our Fed to also start lowering rates. What will also be important coming tomorrow is the longer run expectation for the federal funds rate. Now, back in December, the Summary of Economic Projections, 2 of them ago, right? Not this one, but the one before, the Fed was at 2.5% for the federal funds rate for the longer terminal rate, right? Well, they raised that to 2.6%. Do they raise that again? Do they lower that? Do they keep that the same? That's going to tell you, if the Fed is planning on, going back down to a low rate at any time in the foreseeable future. And maybe I shouldn't call this the terminal rate, but the neutral rate. This is basically the neutral rate projection from the Fed. So the dot plot here, what you're looking at, the new one, is going to be compared to this one on screen. And the changes will be very important. And it makes it even crazier again because CPI comes out at 8:30 in the morning tomorrow. And that's going to change markets' expectations. Is the markets going to align more with the Fed or disconnect more from the Fed? We won't know that until this dot plot comes out at 2 p.m. tomorrow, but it could make the disparity, the gap between what the markets expect and the Fed expects, wider. For an example, if we get a really good CPI report coming tomorrow, the markets might say, oh yeah, we're going to get at least 2 or 3 cuts from the Fed this year. Whereas the Fed might say, it was just another good inflation report. We need more clarity. We're only going to give you 1 cut this year. That could really widen the gap between where the markets are and the Fed is, and thus make that 2 p.m. to 3:30 p.m. Window of the Fed. You get the report at 2 p.m. You get the conference at 2:30. It usually ends around 3:30. It could mean that period of time tomorrow is going to be even more volatile. Now, it's actually pretty interesting what you've seen today in our markets. Overall, it was a pretty risk-off day, but here at the time of recording this video, you are actually seeing a rally back for small caps. IWM hit a low today of $198 per share, and you've rallied back up to about 201. You were down about 1.5% at the low of the day. You're only down 0.2% now. And if you take a look at the VIX was up about 3.5% at one point today. Now it's only up 1%. The Russell is the underperformer. The Russell 2000, at least over here on CNBC, is down about 0.43%. We know it's only down 0.2%. CNBC is kind of has a lag time to update their indexes. The Nasdaq's doing well, up 0.5% today. The S&P is doing well as well, up about 0.2%. The Dow is also lagging behind, down about 0.3%. One thing that did help the markets out today quite a bit was a 10-year Treasury auction for $39 billion that came in lower than expected. So that was directly saying people actually went out and bought the bonds. And at one point today, 10-year Treasury yields were only down about 1 basis point, and now they're down almost 6 basis points. Now, also, as I explained in the last video, if you're looking at the options chain for the S&P 500 that expires by this Friday, there's a lot of investors that are nervous as hell right now, okay? That's kind of the only way to put it. On the call side, you have open interest of 11.58%. On the put side, 88.5% open interest. So investors are buying a lot more puts than calls. The put to call ratio on an open interest basis, the contracts that are currently held in brokerage accounts, is 7.64. A 1 would be an equal amount of calls and puts. So you have 7 times more puts for this Friday's expiration on the S&P 500 than calls. As a contrarian by nature, I think that means stocks probably go higher. Now, Nick Timiraos, a journalist with the Wall Street Journal, he is out with a new article on the Fed and what the Fed is going to do tomorrow. He is widely seen by a lot of market participants as, quote, the Fed's mouthpiece that kind of gets information from the Fed before it's released to the public. Now, whether or not that's true and he does get information before everyone else, we don't know, but that's kind of the rumor on Wall Street for a while now. Nick Timiraos writes, the Fed's catch-22. They don't want to cut without more convincing evidence their policy stance is as restrictive as they think it is. Big shocker. They say that all the time. He goes on to say, but some are uneasy. It will be too late to avoid an unemployment downturn by the time they see the evidence. Wow. Let me read that again. But some are uneasy. It will be too late to avoid an employment slowdown by the time they see the evidence. So some officials on the Fed are getting uneasy based on some of the weakening economic data that we have seen recently. Nick Timiraos says a quiet meeting. The Fed's hawks aren't really agitating for a hike. They just want to put the kibosh on any cutting conversation. And the doves recognize they probably don't have enough data to push for a cut in July. So by default, there's unanimity over wait and see. Nick Timiraos says, but. Rarely is there a meeting where the data released on the morning of the meeting could influence the thing that everyone will watch at 2 p.m. That's the case Wednesday, when the release of the May CPI could move 1 or 2 rate projections in the SEP. Nick Timiraos says, so Wednesday's unusual macro doubleheader might yield an unusual last-minute change on where the median or midpoint of the 19 policymaker projections land, if only because the line between a median of 1 or 2 cuts seems like a toss-up. Wow, that was actually a lot of information. He's either going out on a massive limb here and making speculations, or he actually does have some inside information. He's basically saying right now, the Fed members that are doves are more concerned about the employment market, that by the time it looks like they should be cutting rates, you're already going to be in a recession. The hawks know that there's not enough evidence to vouch for a rate hike, but not enough to be okay with a cut as well. And that the data coming out tomorrow could really sway where the median, projection is for the Fed funds rate by the end of this year, and could give the doves a little bit more of a foothold to say we may need to cut rates. And the fact that there's even a conversation among Fed officials whether or not they should cut rates in July, I think is pretty dang important, because we get our CPI report coming tomorrow. But we get the June CPI report for this month coming out around July 12th, around a month from now. So if that inflation report also shows more disinflation, which it's expected it will, then I think you're making a logical argument that the Fed should be cutting rates coming July 31st. Because if they don't cut rates coming July 31st, they have to go all throughout the month of August until the September Fed meeting, and by then the economy may already be in a bad place. I mean, I don't think the Fed is stupid by any means. They've seen the data. They know what I'm about to tell you. 652,000 full-time jobs were lost last month. That's not a sustainable trajectory. So back to what Tom Lee said in the beginning of this video, right? I do think from that standpoint, the Fed's going to be a little bit more dovish than the markets are expecting. Now, if the Fed shows competency, that they're not going to let the economy enter into a recession, and Fed Jerome Powell's actual conference is going to be important for that, and hopefully he provides some clarity on recession risks and what the Fed is thinking about in terms of actually cutting rates, well, that could prompt a lot more money to enter into small cap stocks. And over the past couple of days and even weeks, small caps have gotten pretty destroyed, and that could lead to a real outperformance. Now, I say small caps, but this goes for interest rate sensitive companies alike. Think solar companies, think, high multiple stocks, think companies that need to just raise capital in general, heavily financed products like a Tesla or other car companies. They would also benefit quite a bit from rates going lower faster. Also, something that is not talked about a lot is when the Fed cuts rates, it actually lowers the odds of a recession, which is like a double whammy, right, of good news, because you're not only cutting rates, easing borrowing pressures and economic activity can maybe start to rise a little bit, but you're also psychologically reducing the odds of a recession. And hopefully get people to spend more money, and that's ultimately why the odds of a recession do fall. Which at this point, the odds of a recession falling via the Fed starting to cut rates sooner rather than later could spark a huge rally in the areas of the markets that need it the most, like small caps and interest rate sensitive stocks. And if you guys want my honest opinion, I'm very bullish heading into tomorrow. Now, of course, could things go sideways? Yes. But if Nick Timmerhouse is correct and presumably he's getting information from the Fed, those are pretty specific statements to make. That's a good sign CPI is going to come in at least around expectations. If not, it actually sounds like maybe lower than expectations. I mean, even if you take a look at the average stock and the breadth of our markets, you can see 39.76% of stocks are currently above their 50-day moving average. You're actually seeing about 2.5% of stocks today falling under that 50-day moving average. This is down from a higher point that we have seen recently around mid-May, where 63% of stocks were trading above their 50-day moving average. So you're definitely seeing the average stock doing pretty bad in the last month or so. CNN's Fear and Greed Index is neutral today at 47 or 45. Yesterday it was at 47. You're still neutral today, but barely holding on to neutrality. You're basically in fear at this point. So we will see what happens. Let me know what you think about all of this information down below in the comment section. And although I want to be very clear, tomorrow is important with the Fed and CPI, but really when it comes down to Tesla, Thursday is still the important day. And it will take place at 4 p.m. Eastern Standard Time, so right after the closing bell of the trading day. So you're not going to have a chance to get any options. You're going to be stuck with whatever options you have, whatever shares you have. So keep that in mind and make your choice before the end of the trading day coming tomorrow. And as I showed in the last video, if you take a look at the entirety of options trading for this Friday's expiration for Tesla, you have open interest of 84.5% calls, 15.5% puts. So it seems like people are pretty optimistic that Elon's package will get approved. Although at the same time, you have seen a lot of big money trades from institutional investors and money managers that have been hedging out their positions, and that has led to a lot of shorting in recent days of Tesla stock. And if Elon's comp package goes through, that's going to lead to a lot of instantaneous buying of Tesla. So let me know what you think about all of that information down below in the comment section. Again, I still think there's a 75+% chance that Elon's comp package does go through, and that leads to a pretty aggressive rally for Tesla. If that is also coupled with CPI falling and the Fed being on the, dovish side, that's going to lead to something that could be even better. So hit the like button, subscribe to the channel. Let me know what you think about all of this information down below in the comment section. But most importantly, tell them what you wanted to say.
To the moon.
Tesla to the moon. That is right. Got to get them off started right, huh?